Good afternoon. My name is Tamal Datta Chaudhuri. I am Dean and Professor of Calcutta Business School. Today, I'll be taking you through a presentation on an arbitrage trading strategy called pairs trading. It is a strategy which is very commonly used by many traders. What I'm going to do is that I will describe the strategy first. Then I will tell you about a predictive model which we have developed, with the help of which we can efficiently predict movement in pair of prices. So let me take you to the presentation. Now, as I mentioned in the beginning, it's a presentation on pairs trading. Now, pairs trading is an arbitrage strategy. As you can see from the screen, it's a ratio of prices of two stocks. It could be two indices. It could be two currencies, which I'll come later on. In order to have an efficient solution and a predictive framework, generally what traders would do is that they would take ratio of prices of two stocks which belong to the same sector, whose basic industry outlook is the same. However, since stock prices are random, one may see this ratio to fluctuate. But a property that we exploit in trading in pairs is that although the ratio prices fluctuate, it has been observed that these ratios are mean reverting. I'll come to the mean reverting a bit later. The mean reverting part basically is the arbitrage strategy basically follows like this, that if the ratio rises, it is expected that it would fall. If the ratio falls, then it is expected to rise. Because since both the stocks belong to the same industry and the industry outlook remains the same, the ratio would rise or fall according to the inherent fundamentals of the two companies. So external noise is zero. Why the ratio fluctuates is basically because their fundamentals could be different. Now, since we are tracking this ratio every day, if one price rises, it would imply that relative to the other, it would imply that demand is relatively more than the supply. And arbitrage would generally mean that the moment this happens, the other stock from the similar sector whose prices are falling, there will be a tendency for funds to move there. So eventually the ratio should again, if it is rising, it will fall. If the ratio falls, then it would be rising. One example of the ratio rising would be that the price of one stock is rising faster than the other. Now, the trading strategy is that if the ratio is rising, because of the numerator rising at a faster rate than the denominator, the trading strategy would be to short the numerator and long the denominator. Now, if the ratio has increased because of a rise in the numerator at a faster rate than the denominator, then we short the numerator expecting that the numerator price would fall, and we long the denominator expecting that the slow moving stock would continue to rise. As you can see from the slide, the expectation is that the stock whose price is rising faster will fall, and the stock whose price is not rising that fast will continue to rise. Similarly, if the ratio falls, the trading strategy is that we long the faster falling one and short the slower falling one. That is, we buy the one that is falling and we short sell the one that is either rising or falling at a slower rate. So any arbitrage strategy basically involves taking opposite positions in two assets, and here also we are taking opposite positions depending upon the movement of the ratio of prices. Now, as I mentioned in the beginning, the pairs trading strategy can be applied to ratio of prices of two stocks from the same industry. I'll give examples later on. Ratio of spot and futures of the same stock. It could be of the index also. One could have a pairs trading strategy between ratio of Nifty and Nifty futures. It's a very common pair that is traded in the market. The third ratio would be prices of two stocks, not from the same industry, not of similar products, but belonging to the same industrial group. Suppose one can construct a pairs trading strategy based on ratio of prices of Tata Steel and Tata Motors, belonging to the same group, although the products produced are different. The fourth example of this pair, where pairs trading strategy can be applied is ratio of currencies of similar countries. One can look at the euro to the US dollar. One can look at the euro to the Japanese yen. One can try and do a rupee to the dollar, but they are kind of dissimilar in the sense that their macro are different. But within a short span of time, if we assume macro to remain unchanged, then also we can do a pair between the Indian rupee and the US dollar. Some examples I said I would cite. This would be a typical diagram of a ratio of prices. This is between TCS and Infosys. They belong to the same sector, the IT sector. Their product profile is more or less the same. So it is expected that the ratio of prices would remain stable. The diagram shows that although there are fluctuations in the ratio of prices, there is a tendency for it to revert back. There is some stability somewhere in between. The second example is between HDFC Bank and ICICI Bank, both in the private banking sector in India, efficient banks. So the banking sector outlook as a whole is common for both the companies. However, their fundamentals are different, their size is different, their customer base is different. There is a tendency for this ratio also to go up and down, but again you see there is some mean reverting property to it. There is a tendency for it to kind of move away, but then again come back. So if we want to do a predictive framework for this kind of strategy, the characteristic shows that the ratio of prices today would be a function of prices immediately yesterday or day before yesterday. So there's an effect of the immediate lags. History plays a role. Then comes momentum, where the rate of change of the numerator and the denominator should be factored in. The mean reversal property, as we mentioned, should be factored in. And since there is, the ratio tends to, whenever it rises, it tends to fall, and whenever it falls, it tends to rise. One can look at an upper ceiling and a lower, what do you call it? A lower floor, a ceiling and a floor. So when we try to model this kind of a pair for predictive purpose, based on historic data, one should factor in immediate prices because immediate history matters. Rate of change of prices matter, which is momentum. I'll just mention gamma scalping later on. It's not a pair strategy, but uses a similar logic in derivatives trading. Since we are operating on the mean reversal property, so the mean should be specified and the ceiling and the floor should also be specified. If we look at the previous Infosys ICICI example, as we Infosys TCS example, one can see that belonging to the same sector, more or less their movements are coterminous. Although, if we look at this particular uh, period, one can see Infosys, which is in dark green, falling, but TCS rising. Now, this immediately means that the ratio of prices are rising. It is expected that TCS will fall, Infosys will rise, and we will get a situation where we can make some money out of this particular trade. The bottom part of the picture is the ratio of the two prices, which is the blue line in between. Now, if you look at the blue line, one can see that there is a mean reversal to the whole thing, in the sense that there are times when it has deviated from the mean, but it has come back again in that sense. There's a certain amount of flat in the ratio. To model the ceiling and the floor, one uses a technical indicator called Bollinger Band. Bollinger Band is nothing but, if you look at the blue line, which is the actual ratio, then one takes a 20-day moving average of the blue line, which we get the middle line, and then we do plus minus 2 sigma, which is the volatility, and we get the band. So the plus 2 sigma gives me the upper band, which is the ceiling, and the minus 2 sigma gives me the floor. So ideally, conceptually, in Bollinger Band technical indicator analysis, the actual series, when it hits the upper band, should revert back. When it hits the lower band, it should rise. So this gives us an overall idea as a technical indicator in which way the ratio is going to move. It helps us in taking positions. The middle panel is the momentum of the ratio. The momentum of the ratio is important because it shows that there are times when the momentum is right, the momentum of the ratio of prices is rising. It shows that the numerator is rising at a faster rate than the denominator. When the momentum is falling, it means that the denominator is either falling at a faster rate than the numerator, or the numerator is rising at a slower rate as compared to the denominator. Now you see, all these elements have to be taken, and momentum considers history, immediate past, because it is PT minus 1. And this becomes important to generate the movement in the pair of prices. So in terms of a predictive framework, if we put down the diagrams in terms of variables, on the left hand side, the explanatory variable would be the ratio of prices. On the right hand side, the endogenous variables would be, or the explanatory variables would be, the ratio of prices in period T minus 1, ratio of prices in period T minus 2, period T minus 3. So to immediate 3-period lagged prices to capture history. Then comes the 3 momentums with a lag. This is to capture the rate of change of prices in the last 3 days. The mean reversal property needs the mean to be specified. So we take the actual price minus the 9-day mean, that is the simple arithmetic mean of the last 9 days pair of prices. And Bollinger Band, as we described, is basically the 20-day moving average plus 2 sigma, 20-day moving average minus 2 sigma, and this gives me my ceiling, the minus 2 sigma gives me a floor. So what have we done? In the predictive structure, we have taken, in order to model the entire pair trading strategy, we have taken lagged prices, lagged momentum, deviation from the mean, and the ceiling and the floor. This predictive model is present in a paper that we wrote with my 2 co-authors, Indranil Ghosh and Priyam Singh. where we applied machine learning tools in predictive modeling of pairs trade in the Indian stock market. And we took a time period of, I think, around 10 years. And we also did an efficiency analysis that we took some control data where we ran it, then we ran it on some testing data to see whether our model was efficient or not. So we have actually worked on a predictive modeling structure in the pairs trading area, applying machine learning tools. The tools that we used were support vector regression, random forest, and adaptive neuro fuzzy inference system. And the efficiency measures that we used were mean square error and mean absolute percentage error, MSE and mean. And the results indicated that we did achieve a certain level of efficiency in terms of prediction from our model specification. Now, as I mentioned in the beginning, a similar kind of, not a pair trading, but a similar kind of logic is used in derivatives options trading, which is called gamma scalping. And it basically says that people who are familiar with options trading would know that if you consider a long delta, say a long call, which has a long delta, which has a high gamma, then if it is in order to hedge against underlying movement, the hedging strategy is to short the spot. Now, as in the pairs trading, in a high gamma position also, we expect prices to reverse. So there will be a reversal in the option price. So when prices fall again, we'll get delta neutrality. So the underlying is taken care of. But because prices we expect it to fall, the short position which we took on the hedging strategy, on that we make money. So gamma scalping kind of uses the mean reversal property of the underlying also to make money. So I hope that I have been able to explain this arbitrage trading strategy called pairs trading strategy. You can do your own analysis. You can start playing in the market. If you are playing in the spot market, if you are playing in the underlying market only, say TCS Infosys, then remember the short position has to be cleared every day. So you have to get out of the pair at the end of the day. But if you are doing between Nifty spot and Nifty futures, you can carry it over, because in futures, you can carry over the trade. So thank you very much. If you have any queries, you can shoot questions at a later date. Thank you.